Hi everyone, welcome back to the USCPA classes for financial accounting and reporting. In this particular video, we'll be covering in detail about employee compensation and benefits and the type of pension plan which is applicable to the employer and employee and how to do the accounting of the same. So let's dive into to understand more in detail.
Hi everyone, welcome to the FAR class. Today we'll be starting with the compensation and benefit, and then after we'll move on to the stock-based compensation, and then last topic, if time allows, we'll start with inventory. Otherwise, we'll start inventory tomorrow morning. Right. So in the compensation and benefit, there are two types of compensation. One is like during the service period, what all compensation you receive or benefit you receive, and there are certain benefits which you receive after the service period, generally like after the retirement, or it may be like voluntary retirement, or it's being like based on time retirement, right? So let me slightly increase the size. Is it more visible to you, everyone?
Yes.
So first thing is like during the service period, what all additional benefit you receive. Generally, if you have seen, there are many companies who have paid holidays kind of inbuilt into their packages. Like if you see in your company also, there are certain paid leaves and there are certain sick leaves also. And then beyond that, if you take the leave, that is like deduct from your salary. Right. Generally, if you see like in MNC, we have around like 18 days paid leave and then 5-day sick leave kind of policy for the leave policy, right? Same if you see like those paid leaves which company provide, even though you are not working, but company is paying the salary for it, right? Same way for the sick leave also, even though you are not working, but the company is paying salary to you. So there is some cost attached to it. Right, that is called during the service period compensated absence paid by the employer to the employee. So it can be for vacation, it can be for illness, it can be for holidays, for which expected that employee will be paid. So for this, whether you need to accrue the liability or you are not required to accrue the liability, if all these four conditions met, then you need to accrue the liability. If those conditions are not meeting, then you are not required to accrue the liability. For example, if you just assume like in the sick leave is given to you, let's assume 5 sick leave in a year has been provided to you. But generally sick leaves are not carry forward, right? Have you gone through your leave policy of your company by any chance?
Yes, sir.
Ayush, Prashant, what is the leave policy you have?
सर ईएल ही कैरी फॉरवर्ड होती है, सिक लीव कैरी फॉरवर्ड नहीं होती और कैजुअल लीव्स होती है वो भी नहीं होती। अगर
Yeah.
उसमें भी वही 30 लीव्स हैं तो उसमें जो मेडिकल होती है ना उसमें 7 कैरी फॉरवर्ड हो जाएंगी, बट दे विल नेवर कॉम्पेंसेट यू फॉर दैट। दैट इज आल्सो ईएल। मेडिकल तो टोटली एक्सपायर हो जाएगा।
Yes, yes. So the leaves which completely get expired, for that we are not required to do accrual at year end, because any which ways it will get expired at the year end, right? But the leave for which you need to pay the benefit in future, which are like carry forward, right? Either, if you remember, like in old days, like maybe if your parents were working, or maybe like very elder brother or sister might be working in any government organization or any such PSU kind of thing. So earlier, most of the company were having a policies of carry forward for 30 days, 60 days, 90 days. Or I've seen like a couple of the government department, they have like 120 days carry forward. That means they're not taking leave in current year, but it can be carry forward for future until your retirement up to like 120 days. 120 days mean almost 4 months. Right. So in that case of scenario, company need to accrue for the liability, because in future when the employee may avail those benefit. Right. If the employee is planning to avail those benefits in future, that means it will be payable in the future salary. Right. Make sense? Are you guys with me?
Yes, sir.
So keep all those two things in mind. One is sick leave category, in which generally it is not carried forward. that means it will get expired, then we are not required to book the accrual. But other than that, there are paid leave which are like carry forward. Like if you see nowadays, company keep maximum 15 days carry forward policy, right, to just to avoid like this unforeseen situation, or you can say increasing their liability burdens for the future. But earlier days, I have seen in many companies, especially in PSU and government company, they have like 60-day, 90-day, 120 days accrual policy, or you can say carry forward policy. And so accordingly, their accruals were really high, right? Just keep these two scenarios in mind. Let's understand these 4 points. First one is employees' right to receive compensation for future absence for the services already rendered. That means you earn, let's assume you have 18-day paid leave in a year. That means every month you are earning 1.5 days paid leave. So it means if you see the first point, you have already worked 1 month. For that, you have already earned 1.5 day of paid leave, right? That's how like accrual generally work. Second is obligation relates to right that was to accumulate. So whatever is like accruals, or you can say your you can say number of days or number of months you have worked for the respective, you will do the calculation of number of days you have accrued, and accordingly it will accumulate period over period. Or there are certain companies who have the policy to limit that maximum this much of accumulation is possible, right? To that extent it can go and accumulate, but beyond that it will be forfeited. Third is payment of compensation is probable. That means the company is going to pay in future, either in cash or in lieu. So in cash means like leaves are encashable. Have you heard about leave encashment? I know in Big Four we don't have policy of leave encashment, but if you see in many companies there are policy of leave encashment, like people can encash their leave also. Have you heard about this term? Any of you?
Yes, sir.
Hmm?
Yes.
So in that people can encash their leave at their basic HRA and like some amount. But generally when you do the encashment, the travel allowance and certain other components company do not consider it. Right. But whereas like possibility of encashment, that means in future the company is going to pay you money, right? And the pay you money is based on the future salary, right? The last one is amount can be reasonably estimated, and then you can estimate the amount, how much is the expected outflow of the cash or in lieu you might be end up paying for the compensated absence, and that's how you calculate the liability for the leave encashment or leave payable, right? Most of the time like company do involve actuarial in this. So we'll be discussing what all assumption that actuarial take and how actuarial do the calculation for the compensated absence. We will be discussing that also. But just as of now, just understand the two scenario, or maybe two categories basically, in which this compensation and benefits are being provided to the employee. Second category is after service period. After service period means retirement benefits. Retirement benefits include pension, majorly like pension after the retirement from compensation earned during the period. So when you are earning, when you are working with the company, so you might be contributing few amounts and company might be contributing some amount and depositing either into a contribution plan or defined benefit plan, from which you'll be getting the pension after the retirement. Right, we'll be discussing what is defined contribution plan and what is defined benefit plan. We'll be discussing that, but just high level for an understanding purpose, let's assume you are contributing something and your employer is contributing something during the job. And after your retirement, whatever you have contributed and whatever your employer have contributed, out of that fund, along with the interest, you will start getting the pension. So that is called pension plan. So pension plan have generally three parties, which include like employer, which is sponsor of the program, employee, and the trustee. So trustee, it may be financial institution, bank, or insurance company, where both the party generally deposit the money and who maintain those money and invest that money to earn the profits. And accordingly, they would be in a position to give you better return when you are availing the pensions, right? Any doubts so far? What is during the service period benefit and what is after the service period benefits? Before we jump forward,
No, sir.
right, everyone? Prashant, Rahul.
Yes. Yes, sir.
Okay.
Sir,
So
which
now,
is
yes,
which AC is this?
this is 960.
Okay, okay.
Type of pension plan. So type of pension plan, like we discussed earlier, there are two type of pension plan. One is contribution plan, one is defined benefit plan, right? You may get confused. Sometimes you'll see the question and you need to identify which category of plan is it. Is it a contribution plan or is it a defined benefit plan? So let's understand what is the difference between contribution plan and defined benefit plan and how it actually works. In the defined contribution plan, as the name suggests, it is a contribution plan in which employer makes certain contribution and employee makes certain contribution, but the total contribution they deposit to the third party. Third party can be bank, can be insurance company, can be financial institution, can be a trust, right? Where they park all this money and that trust, financial institution, and bank take the responsibility of investing that money. So investment risk is with that trust, financial institution, or insurance company, but not with the employer, right? That is a key difference between defined benefit plan and contribution plan. In the contribution plan, responsibility of employee and employer is just to deposit their piece of contribution to the third party. Third party can be trust, it can be financial institution, it can be insurance company, right? And that trust, financial institution, or insurance company take the responsibility to invest that money and earn the profit so that in future they can pay the sufficient pensions to the required pensioner. Second thing is employer obligation is to contribute his share only. So the main difference between contribution plan and benefit plan is the investment risk, right? So that is totally lie with the third party. Whereas if you see in the right hand side, defined benefit plans. So in the defined benefit plan, accounting for defined benefit plan is generally more difficult than the contribution plan, because in the contribution plan, you just need to debit the expense and pass on that contribution to the respective third party, right? Whereas in the defined benefit plan, expense are based on the estimate of future benefit rather than on required contribution. So here, every time when you are booking the expense, whether it's monthly or quarterly, you need to do the estimation of future expenses. And accordingly, you need to book the expenses. So it required more judgments. It required involvement of actuarials. It required involvement of specialists. And second thing which make it different from the contribution plan is the risk of investment. So here employer bear the risk of return on planned asset. Planned asset means investment. So here employee contribution and employer contribution both lies with the employer, and then employer make the investment to get the sufficient return so that in future he the employer can make the pension payment to the respective employee. But how it actually work? So it is not easy, because in future how much pension you need to pay, that is first you need to estimate. So it involves a lot of estimation. Then what is your current investment? How much return is it giving? Will you be having a sufficient fund to pay the pension to your employee, which you have committed in future or not? And accordingly, if there is any deficit, that you need to make additional contribution. So here, like employer has more responsibility. Whereas in the contribution plan, employer has the responsibility up to the amount of contribution part of the employer to deposit to the third party. That's it. Right? Any doubt here? What is contribution plan? What is benefit plan?
No, sir.
Right? Ananya, Santrupti, Rahul.
Yes, all good, sir.
सॉरी
So
सर, मैंने अभी ज्वाइन किया है। 1 मिनट का छोटा सा ब्रीफ अगर आप दे दो, एक छोटा सा, मतलब पूरा एक्सप्लेनेशन नहीं, मैं फिर से नोट्स पढ़ लूंगा। सॉरी
okay, okay. So no worry. Before you came, we have just started on compensation and benefit, and that we discuss about there are two category of compensation and benefit. One is during the service period. One is after the service period. Right. So for example, you have compensated absence like leave encashment policy that you earn during the year as well as you encash during the year or avail during the year. Whereas there are certain benefit which is being provided after the service period, like retirement benefit and pension plan. Then we just jump onto the type of pension plan. So in type of pension plan, we discuss about contribution plan and defined benefit plan. There are only two category of pension plan. One is contribution plan, the other is defined benefit plan. Contribution plan are those plan in which employer and employee make the equal contribution and deposit that contribution to the third party. Third party can be trust, can be financial institution, or can be insurance. And that third party take the ownership of that fund and make an investment. Hence, the risk of the investment is lie with the third party, not with the employer. So that is a major difference between contribution and the defined benefit plan. Whereas in defined benefit plan, employee make their contribution, employer also apart their contribution, and then they make the investment decision so that they will be having sufficient return and investment in hand so that they can pay the required pension to their employees in future after their retirement. Right? Make sense? Gurmeet?
okay, got it.
So,
Thank you.
One query, sir. In case of DCP, who invest? Like third party, right?
no. Employee make a contribution, employer make a contribution, and that contribution is deposited either in trust or to the financial institution or to the insurance who run those benefit plans.
Okay.
Like in
Third
US,
party.
yeah, in US, like there are many trusts, many big companies, they form their own trust also sometimes, right? For that, there's a separate audit called 401k audit. Have you
Okay.
guys, any of you have heard about this 401k audit?
I heard 4OK, but I have not heard about the audit.
Yeah, so 401k is basically employee benefit plans. So that individual trust or maybe financial institution run for many company, there's like contribution, you can say defined benefit plans as well as financial institution. So each plan need to be get separately audited and that required to be report in 401k format. So that's a legally defined format. For same way like for financial statement, you have a standard format of 10K. Right? Same way for the employee benefit plan, the financial statement of employee benefit plan need to be present in 401k format. Right? Any doubt?
Sir, this 401k is just only about this pension or including some other benefits and other plans also?
Yeah, other plans also. All employee related benefits, which that trust or maybe financial institution or insurance company is managing, but not the salary.
Okay.
Only like retirement plans. Only
Okay,
retirement
so
plans, right?
only this DBP.
DCP.
Oh, DCP.
DCP.
Yes, yes,
Mhm.
yes, yes.
Yeah, DBP company maintain at their own.
Okay.
And for that also company required a separate audit of 401k. Maybe let me Google it out for you. Let's see if we have. So this is all 401k plan. What you can do, just check for any company. Let's say this is 10k. Yeah, maybe I'll do some research and send it to you. One format of 401k report. Maybe I may have something. Maybe like during the break, I'll check and get back to you. I'll send you a format of 401k report so that you can correlate like how it looks like.
Okay.
Cool. Note over here is accrued liability only if employee have a right to carry forward the compensated absence after the period, right? So like we were discussing earlier also, the compensation for which you can carry forward as an employee, then only the liability need to accrued. If you cannot carry forward, then accrual is not required. Like for sick leave, generally are not carry forward, right? So in that case of scenario, you are not required to accrue the liability for sick leave, but there are paid leave or casual leave. So most of the time paid leaves are carry forward, right? In that case of scenario, you need to accrue the liability. Last line, if you see here, generally sick leaves are not carry forward. So company expense of as incurred rather than creating a liability for sick leave. Now coming to the defined pension plan. So defined pension plan, you need to do the accrual and you need to consider certain assumption. And I know like we also use actuarial, right? So actuarial, what all assumption generally actuarial take for the calculation of liability, which is required to be booked in your financial statement. So there are two type of assumption. One is financial assumption. Second is non-financial assumption. So in a financial assumption, which include compensation of the employee or any change in the compensation of employee from previous year to current year. Second important financial assumption is discount rate. So what is the discount rate appropriate to calculate the estimated future liability? So generally, there are multiple things which actuarial do consider to identify the discount rate, right? That may be your borrowing rate or that may be the rate at which you need to pay back to your employees that retirement benefit plan. So if you have already committed, let's assume 5% pension plan, that means whatever the contribution you are making or your employees making, you need to give them at least 5% return, right? So then the discounting factor, discounting rate you need to consider is the 5%. Other than that is non-financial assumption. Non-financial assumption include mortality rate, right? Mortality rate means death rate. Like generally, what is the life expectancy of the employee, right? If you see in the US, the general life expectancy is around 84 years, right? So according to that, there are certain numbers which derive from the mortality rate based on the current age of the respective employee and the mortality data. And there are some probability factor which we do need to multiply based on the mortality rate. And then second thing is withdrawal of workforce. That means attrition rate. So like before we started the class, we were discussing about 44% attrition in like many big fours last year, right? Same way in the companies for which you are doing like actuarial valuation or you're doing like accruals for the defined benefit pension plan, you need to understand what is their attrition rate. If the attrition rate is high, that means you need to pay less in future because people would be leaving you, right? If attrition rate is low, then probability is that most people will be retire from your organization, and in future you need to pay more liability, right? So these are the assumptions you need to keep in mind when you are calculating the defined benefit pension plan. Any doubt? So far so good?
Yes, sir.
Okay. So here, have any of you seen any actuarial report by any chance? Have you guys seen any actuarial report?
I have seen it, sir.
You have seen it?
Mm.
1 second. So you have all this financial, right? I'm not sure how many of you have seen it, but I'll make sure at least once in the classroom you'll see most of it. So here, if you see like disclosure part of the pension and other post-retirement benefit, here it is being clearly mentioned, defined benefit,
Pension plan.
right? Defined benefit pension plan. Here, if you see the benefit provided to the defined benefit covering this US and Canadian salary employee and employee in certain non-US location also, and then after, if you see, they have given the breakup about like salaried employee and hourly employee, how much is the liability for them, and then they are giving like we are expected to contribute approximate 70 million for our US non-qualified plan and approximate 500 million to our non-US pension plan based on the current assumption. This other benefit, and they have contribution plan. 1 second. Yeah. So this is their pension and OPEB obligation of planned assets. So these are like their if you see, this data is taken majorly from actuarial report, in which if you see, they give you like opening balance of the benefit obligation, what is the service cost during the year, what is the interest cost during the year, what is the actuarial losses during the year, what are the benefit we have paid, what is the foreign currency translation adjustment or any curtailment or settlement. So then you will see like change in plan assets. So this is how you need to give the disclosure. So here, if you see, here if you see, this is all about change in benefit obligation piece. And then change in planned asset piece again, beginning balance, accrual, return on the plan asset, how much you have got the income on the plan asset, then employer contribution, then foreign currency translation, settlement, curtailment, and ending fair value. So this is about change in the plan asset disclosure. Then you need to give the disclosure on amount recorded in the consolidated financial statement, in the current liability, non-current liability, and the net amount you have recorded. So here you'll give the disclosure from the perspective of current and non-current classification. Then the amount recorded in the accumulated other comprehensive income or loss. So how much amount has been transferred to OCI, that has been also given a separate disclosure. Right, this is how you need to give the disclosure. And assumption, let me show you. Following is the accumulated benefit obligation, fair value plan asset, defined benefit. This is projected. So just look at these kind of disclosure will go in the financial statement. And yeah, so then you need to mention the assumption, what all assumptions you have taken. Or if you just look at, go to the Google and say actuarial report. Actuarial valuation. Is it visible to all of you? Is it visible to everyone?
Yeah,
Not
थोड़ा छोटा है
very.
but हाँ.
Yeah, maybe. Maybe. Do you have like any actuarial report for any of your employee by any chance? Any of your client? Not really.
नहीं sir.
Let me see if I have something. Not here. But I'll find. I'll show you like after the break. I'll show you some actuarial report also. So in that you will see there are a lot of assumptions they consider. Key assumptions are like this financial assumption, which is like change in the compensation from previous year to current year, and the discount rate. Because discount rate generally it has been considered, which is committed rate of interest or committed rate of return provided to the employees. And non-financial assumption include mortality rate and withdrawal of the workforce, which is like attrition rate, based on which like actuarial do the calculation on the numbers which the company do provide. Right? Theoretically, we all comfortable.
Yes, sir.
But maybe like during the lunch, during the break time, you can also do some research of actuarial report. I'll also try to Google it out, and so that we all can see how actual report looks like and how these assumptions are being considered by the actuarial and the impact of these assumptions. But how it will go into the financial statement, that we have discussed, right? This is how you need to present into the financial statement for all the benefit plans and obligations. Make sense?
Yes, sir.
Okay.
Yes sir.
So here is the projected benefit obligation. What is projected benefit obligation which you need to present in the financial statement? If you see, oh, sorry. If you see here, you have ABO, accumulated benefit obligation. You have PBO. PBO means projected benefit obligation. And this is your accumulated benefit obligation. So this you need to present into the financial statement. What is PBO? What is projected benefit obligation? Projected benefit obligation is used present value of pension benefit obligation based on the projected compensation, right? Projected compensation means like what will be the compensation in future. So generally it need to be calculated based on the increment year over year your company provide, or in future you are expecting to provide the increment. And you know, like this assumption is also comes under the financial assumption, because the increment will directly impact the compensation, right? So it may be possible that in previous year over year your company might be providing, let's assume 10% increment. But in future, you are expecting a big inflation or deflation, right? And then on account of deflation, you thought it's not required to provide more increment of the salary, because any which ways with the current salary, purchasing power of the employees have increased on account of deflation, right? Or maybe like if I give you a very like a practical example, like many Indian go outside to African countries and do work over there, and there they get the salary in US dollar. So how like the employer over their work, they consider the impact of change in US dollar to INR, and after that, if required, then they provide an increment to the employees, right? Normally, if you see, on an average, industry practice is to provide average 10% of increment to their overall compensation. If you see like historical trend of period over period increment, right? But for example, if and as an Indian, you go to like any African country where you get the compensation in US dollar, and US dollar compared to INR have diluted, let's assume 6%, then they will give you additional 5 or 6% increment, because they'll say like you're any which ways getting more benefit of the dilution of INR compared to US dollar. Are you getting my point?
But so what if the person is already living in, maybe, for example, in, like, he settled there in Africa only, or probably he has a family in US, so he's not going back to India and spend that money in INR.
So in that case of scenario, two things. You said two example. One is like person who is settled in Africa, right? The person who has already settled in Africa, so, so their local currency will also keep on diluting compared to US dollar, right? For them, any which ways, like the benefits are more, because in the local currency they are getting more. For example, if I say about Nigeria, so let's assume you join any company in Nigeria back in 2000, let's assume on January 2023, right? At that point of time, let's assume US dollar to Naira was around 400 Naira per dollar. And now in the next year, when it comes to increment cycle, so the Naira has gone down to 450 Naira per dollar. That means Naira has already diluted 12.5%. Right? And if they give you like increment of 15%, that means they're saying 12.5% increment in which ways you have got because of the dilution of Naira. Right? Only 2.5% increment in the salary you'll be getting. But if you are in good terms, you'll get maybe 5%, but that's how generally they do benchmarking. Now, another question which you have is, if the person family lives in US and he came to Nigeria or maybe to any African countries for the work purpose, and he's spending in the US dollar in US, right? So in that case of scenario, they need to do one-on-one negotiation and discussion with the employer.
Okay, got it. Yeah.
Right? Any doubt, guys, on this? Now coming to this projected compensation. What is projected compensation means? Like in future, how much increment you are giving. So for example, if you see like normal trend of the increment is 10 to 12% in India, if I say about Indian market, right? But if you see, if the company who is in IT domain, right, their increment trend has changed in last 3 years, drastically changed in last 3 years. You know, like they're also like struggling to understand the market at this point of time, like where exactly the trend of increment is going, and for them it is being more complex to estimate and project the compensation in future. If you see like in IT domain, if like person who is a fresher may get 20,000 or 30,000 INR, But the person, as he get 1 year of experience, let's assume on Python, Django or JRD, all these high tech technologies which are being now used for development part, right? In just 1 year, they switch to like 50,000 from 20,000 or 60,000. If the person is like 3 to 5 year experience, it will be hitting more than 100,000 rupees, right? So for them, it's very difficult to project, right? For the company like EY, PwC, who is more stable and sustainable, or maybe manufacturing company like JCB, Goodyear, Maruti, Hyundai, for them it's more stable. So there it is easy to project like how much 8%, 10%, or 12% increment again. But for some company who are in like IT domain like HCL, TCS, Infosys, for them it's very difficult, right? But the key difference between projected benefit obligation and the accumulated benefit obligation. Let's understand what is accumulated benefit obligation. Accumulated benefit obligation is the present value of the pension benefit obligation based on the prior compensation. That means what is your current compensation? Keeping that in mind, what will be the future cash outflow I need to manage to pay all the liability is called accumulated benefit obligation. So difference between projected benefit obligation and accumulated benefit obligation is, in the projected benefit obligation, you project the future compensation and do the discounting and make it at a present value. Whereas in accumulated benefit compensation, you consider the current compensation. Yes, Gurmeet.
करंट और प्रायर, यहाँ प्रायर लिखा हुआ है, सो बेस्ड ऑन प्रायर से मीनिंग लग रहा है कि बहुत पुरानी पिछले साल की कॉम्पेंसेशन.
Maybe like current year, sorry. Where?
ऊपर सर accumulated benefit
Where oblique.
सर एक और मेरा क्वेश्चन था, मे बी वेग ना हो. डू दे फैक्टर इन फैक्टर्स सच एज जो ले ऑफ हो रहे हैं आजकल स्पेशली इन आईटी सेक्टर?
Yes, yes, yes.
हमने कंसीडर किया कि ट्रेंड ऊपर जा रहा है.
If you see like attrition,
Oh,
non-financial assumption, it's already there.
Okay. ठीक.
Right. Look at the note here. PBO, projected benefit obligation, used future estimated compensation measure, whereas ABO, which is accumulated benefit obligation, use prior oblique current compensation measure to calculate the obligation, and PBO use projected future compensation. Next is fair value of plan assets. If you have seen here, you need to give the disclosure of fair value of planned assets. When in this change in plan assets, beginning fair value. Can you see this term mentioned here? Fair value. And then your ending fair value. Right? So this is for planned assets. Planned assets mean the amount you have invested in the respective assets. So you need to give the fair value of the planned assets as well. So amount that the pension plan could reasonably expected to receive for an investment. So whatever the investment you have made, how much money you are expecting to recover out of that investment is called fair value of the planned asset, majorly fair value of the investment which you have made. Make sense? What is fair value of planned assets? The amount which you have invested, how much you are expected to recover. So if you see disclosure part, beginning fair value of planned assets, actual return received during the year, employer contribution you have added, and employee benefits you have paid, you will be reducing it. Any foreign currency adjustment, settlement or curtailment, and then what is ending plan assets. So that is 61077. So that's how you will be doing the presentation and disclosure. Make sense? Can you correlate theory with this financial statement?
Yes, sir.
Yes, sir.
Yeah, Santrupti, Rahul. Ananya?
Yes, sir.
Okay. So next is prior service cost. So prior service cost have retroactive impact of the amendment in benefit plan. So employee bargain agreement impact of additional benefit of employee coverage in the existing plan. So anything which impact your prior service cost, that will have a retroactive impact. So what is prior service cost impact thing? For example, have you seen like labor intensive company, like generally big manufacturing company? If you see like Maruti, you might have heard, right? Tata, Hyundai, Goodyear, JCB, like big manufacturing company, right? Skoda. I'm sure most of you might have heard this, right? So there we have like huge amount of labor, right? And those labor also have unions, right? Have you heard about labor union?
Yes, sir.
Yes,
What
sir.
they do? Any idea?
Sir, so basically they fight or for the rights of the labor, and they discuss with the management what things can be done better for the labor, how compensation can be restructured and all those things.
Yeah, very nice. Same way in US also, you might have heard the name called General Motors. Then we have Robert Bosch. Then we have this Fiat, Chrysler, right? So, and there are so many big companies which are like big manufacturing companies in US, and those company also have like worker unions, and they do, again, like you said, like they fight with the management most of the time for the benefit of the workers. So in that case of scenario, let's assume, like normally for any big company, it's very much structured nowadays. Gone those days, like almost management and labor were fighting. But now it's being more regulated and more structured. So every 3 years, they do compensation bargain agreement called CBA. That's a very standard term used universally nowadays called CBA, compensation bargain agreement. That means every 3 years, management and labor leaders sit together and do the discussion on the future increments of the salary of the worker. Worker means blue collar worker. You know what is blue collar worker and what is white collar?
Yes, sir.
What we are?
White collar.
Unfortunately or fortunately?
अनफॉर्चुनेटली मान लो सर.
Why unfortunately?
आजकल वो ब्लू कॉलर और व्हाइट कॉलर में फर्क है नहीं ज्यादा वैसे.
At least they get like double the overtime.
यहाँ तो
Right?
पैसा नहीं मिलता है.
We don't get overtime pay. Right. So now coming to it, like this blue collar labor union, they sit with the management and negotiate about the salaries. Sometimes they discuss, it may impact few policies which may have retrospective impact. Let's assume like change in, let's assume change in their, you can say, insurance policy, coverage of insurance policy, or maybe change in their compensation from retrospective impact, maybe like some allowance they need to add, right? So as a management, when you are doing accounting, or as an accountant when we are doing accounting, so we need to consider those impact, and we need to do the calculation from the retrospective impact also. There are certain that comes under the past service cost, or you can say prior service cost. So I'll show you here. It is service cost. So fortunately it's not here, sorry. If you see here, it is called service cost, right? So there might be some prior service cost that may not be material, hence it is not been given a separate line item. But if there is any major impact on the overall accrual, then you need to add a separate line item called prior service cost here. Make sense?
Yes, sir.
Next is service cost. Sorry, net periodic pension cost. Net periodic pension cost is a change in profit and loss or income statement. Service cost result from the employee's services rendered during the year. So service cost mean the compensation basically, right? So compensation which you have earned, which employee have earned based on the work they have performed. In that, you'll be adding if there is any interest cost, that is time value of the money result on account of passage of time. Then you'll be adding any actual return on planned assets, including dividend received, increase in the fair value of the investment held by the plan, plus or minus gain or loss recognized. Gain mean decrease in periodic cost, or loss mean increase in periodic cost. So that unrealized gain or loss associated with the change in fair value of plan asset with the change in projected benefit obligation are recognized in the other comprehensive income. So this will go into the OCI. So do you know what is OCI?
Yes, sir.
Other comprehensive income.
See here, the amount recorded accumulated in other comprehensive losses. Right, you have seen like specifically mentioned. And then if you go to the other comprehensive summary of significant component in the accumulated other comprehensive income. Here you will see the defined benefit. Can you see this table? Defined benefit plan. And its impact on OCI. So what is like opening defined benefit plan in OCI and what is changed during the period? Right? Makes sense? That's how you need to make the disclosure in OCI. Right. So coming back to the same note number 15. Then any plus and minus and again this we have discussed. Prior service cost amortized when plan amendment are made. Additional benefit are sometimes applied retroactively, which we have discussed, and then amortization of transition assets and obligation. For that is for first time adoption. If there is any first time we are adopting any new accounting standard, and on account of that, if there is any adjustment, that will go to the OCI and will be amortized over the period and recognized in the net periodic cost over the period. Then next topic we have is corridor for unrecognized gain or loss. So this is only in US GAAP. It's not in the IFRS or not in the NDS. To prevent the accumulated other comprehensive income related to the unrealized gain or loss from getting it too large, GAAP utilize corridor approach. Corridor approach means like in every time when you are having this OCI. So what exactly is OCI? If you remember in the last class we discussed, we park those items which is not majorly on account of the business operation. That means all those 5 category which is being impact of the environment, which is the impact of economic, which has nothing to do with your business, nothing to do with the management. The impact of those things will generally park into the other comprehensive income. right? But the US GAAP has given a corridor to amortize those OCI items, which is specifically to the employee benefit plan over the period of employee benefit plan and charge it to the income statement slowly and gradually to avoid that keep on increasing the base of OCI. This is not permissible in IFRS and neither in NDS. This approach is only and only in US GAAP, and this is the difference between US GAAP and IFRS or US GAAP and NDS. That US GAAP allow the corridor approach where you can slowly and gradually amortize the OCI part of the employee benefit pension plan to income statement over the period of employee benefit plan. Right? Corridor approach restrict the unrealized gain or loss in OCI to the maximum extent of the larger of 10% of the beginning balance or market value of the planned assets, whichever is more. To that extent, you need to retain in OCI, and more than that, you can pass on to the income statement. If unrealized gain or loss exceed this limit, then excess must be amortized over the average remaining service period. That means, for example, if you have $1 million in the unrecognized gain and loss, in that you will see what is the 10% of the beginning balance or the market value of the planned assets, whichever is higher. Let's assume that is 80,000. So 1 million minus 800,000, that is 200,000, you can release to the income statement, but over the period of planned benefit, defined planned benefit, not in a 1 year. And this assessment you need to do every year, right? Last topic or second last topic is settlement and curtailment. Settlement and curtailment means basically the employee relieving or attrition or maybe like death of the employee for which you need to make the settlement, or maybe any injury has happened to the employee and he or she is not capable of continuing the work, and then you need to make some payment to it. That all comes under the settlement and curtailment, and those things you need to recognize immediately, right? Settlement means relieving the employer obligation by paying to the employee, and curtailment means reveal the employer obligation without payment, which is change in law and regulation. It's law.
ये पर जो सेटलमेंट के आगे रिलीव लिखा हुआ है, ये रिलीव स्पेलिंग चेंज होगी।
RELIEVE.
यस,
ये तो सर रीलिव हो गया।
ये दोबारा नहीं जीना, वो एम्प्लॉय दोबारा नहीं लिया ना लॉस हो जाएगा।
Yeah, it's been like some staff has done all typing. You know, I make notes like in the notebook in old style.
Yeah. And then they type
And
it.
then then I give to some staff to do the typing, and then I do formatting also. You see, like
क्लास में होता है नोट्स का आपके?
जब क्लास में पढ़ा रहे होते ना तब मैक्सिमम बच्चे भी
see, like this is like next topic is, for example, investment, which we'll be covering in the next slide, right? This is how like he has done. So I need to do a lot of, like formatting also, make it presentable to you. And then I do review, and then like keep on adding like certain examples.
and all do.
कोई नहीं सर, आप पढ़ाओ, हम रिव्यू कर रहे हैं साथ साथ।
Yes. So real time review. Good. Okay. And then disclosure part is service component, including service cost and gain and loss from curtailment, interest cost. Same, if you see, this is all disclosures, which we have seen here. So in disclosure, like they give you what all benefit plans they have, right? What all respective category of employee and how much is the liability they have, what is the post-retirement plan, what is the contribution plan, right? And then after, if you see, like this is all comes under the disclosure part, right? What are the change in benefit obligation? What are the change in plan assets? What are the consolidated amount in balance sheet for current as well as for non-current? And what will go to the OCI, right? Then after, if you see what is ABO, PBO, all those things are being disclosure part. So if you're seeing the disclosure, you need to give service component, including service cost, gain or loss from curtailment or settlement, interest cost, expected return, and then gain and loss on planned assets, and then prior service cost, transition of assets or obligation. Last note over here is excess of plan assets over the plan benefit obligation, then report as a non-current assets when you have planned assets more than the obligation, right? Generally, the obligation is divided into current and non-current based on like when it is expected to be due. But if there is a plan asset which is more than the liability, that means it is always being due after 12. So hence it is always being considered into the non-current assets category, right? Excess of PBO over the planned assets, report the current liability. Current liability will comes present value of the PBO due in next 12 months. Excess over the planned assets. So whatever is the amount due in next 12 months will go into the current liability, and whatever is being due after 12 months will go into the non-current liability. That's very standard rule of balance sheet. Accounting and reporting of defined benefit pension plan. So this we were discussing in the morning, like employee benefit plan financial statement. So this is comes under the 401k. Maybe like during the break, I'll also do some research on finding out some 401k report, and you guys can also just note it down somewhere and do the research and try to find some 401k format, so that like this we can discuss with the group, or you can share in our WhatsApp group for the benefit of everyone. Then financial statement of defined benefit pension plan must include the following three things. One is net assets available for the benefit as of the end of the plan year. That means statement of net assets available for the benefit. That means how much is the total amount you have in hand which you can invest. Second is change in the net assets during the year. That is called statement of change in net assets available for benefit. Change in net asset means like how much was the opening asset you have, how much investment you have made, how much encashment you have done, and what is the closing balance, right? Adding the interest earned or dividend earned or profit earned on the respective assets. Then last one is actuarial present value of accumulated plan benefit as of either at the beginning or end of the plan year. The effective significance of certain factors affect the year-to-year change in the actuarial present value of the accumulated benefit. So only the item which is having like major impact, you need to give a separate disclosure. If something is not significant to the financial statement, you are not required to do a separate disclosure, right? Any doubts so far?
सर सर वो पेज एक बार
अच्छा, सेम, ओके ओके,
जो सेकंड लास्ट पेज था प्रैक्टिस क्वेश्चन से पहले वाला, हाँ इसमें सर नोट्स में लिखा हुआ है फर्स्ट नोट एक्सेस ऑफ प्लान एसेट्स ओवर प्लान बेनिफिट ऑब्लिगेशन रिपोर्ट एज नॉन करंट एसेट्स. सो ये ऐसा नहीं होना चाहिए जितने प्लान बेनिफिट ऑब्लिगेशन है, मतलब जितनी करंट नॉन करंट में बाइफरकेट हो रही है उतना ही प्लान एसेट भी वैसे ही बाइफरकेट होगा, सिर्फ एक्स अमाउंट टू नॉन करंट एसेट.
that's what I explained. Like if you have assets more than the total obligation, right? That means that portion of assets will be utilized after 12 months. Liability can be amount you need to pay within 12 months and after 12 months. If total liability, let's assume you have total liability of $1 million, out of which let's assume 200,000 is being payable in next 12 months and 800,000 is being payable after 12 months, right? Let's assume this is the bifurcation of current and non-current. And now you have, let's assume $1.2 million of plan assets. So that $1.2 million minus $1 million, that is $200,000. That $200,000 will always be considered as non-current, because the time that that amount you will be liquidating only after paying your current liabilities and the non-current liability. That means it will come after that.
Okay.
Shall I put an Excel sheet?
Hey, sir, I got that. But so you're saying $100 million would be current assets?
No, I'm saying 200
Would
to the
be
extent of current liability.
Sir, not clear. But
This is saying excess of plan assets over the plan benefit obligation. Let me give you an Excel sheet. I'm saying, let's assume you have let's assume this is your plan assets.
right.
And then you have current obligation, and you have current obligation. You have let's assume you have current 200,000 obligation and 800,000 obligation. Right. And this is your 1 million is the total obligation. So what it's saying, 1.2 million minus 1 million. So this will always go into the non-current. Why this will always go into the non-current?
Current utilize over.
First, you will be utilizing the current. Make
Right.
sense?
Right.
Hmm?
And
Yep.
1 million of plan assets would be reported as current assets.
Yes. No. 200,000 will be current. What you need
So
to
rest-
liquidate, what maximum you need to liquidate in next 12 months is 1200,000.
So why are we calling it separately in that case? वो तो दिख ही रहा है कि 20,000 will be current asset and rest 1 million will be like your non-current.
Yeah.
तो हम
Yeah,
call
very
out
true.
क्यों कर रहे हैं?
No, that's disclosure requirement.
Okay.
For the benefit of the user. Everyone may not be a CPA, on the earth. So we need to look at from, like stakeholder perspective.
Okay.
Right? Ayush?
Yes, sir.
Okay. So shall we do a question? Let's do one quick question. What would be reported as a decrease in statement of change in net assets available for the benefit of employee benefit plan? So question is, what would be reported as a decrease in the statement of change in net assets available for the benefits? So statement of change in net assets. Benefit paid to the participant, contribution from other identified resources, contribution from employer, contribution from participant. So if you see here, change in
So
change
to participants here.
yeah, change in net assets available for benefit. So change in plan assets. What is reducing? Can you see this? Benefit period. This is all negative. Right, everyone? Yes, no.
Yes, sir.
Yes,
Right?
sir. Yes, sir.
So this, if you see, is a negative. benefit paid to the participant will reduce out of it. Why it will reduce? Because this is cash outflow. Right? What is benefit paid mean? The employee who are retired, so you need to pay them. Right? When you are paying them, it will reduce from your plan assets. From where is it reducing? Yes, no,
Sir, plan assets वाली जो पूरा वो बनता है उसमें से we will reduce this amount. Benefits paid.
Right, everyone on same page?
Yes, sir.
Okay, so next we have is stock compensation. Maybe we can take a quick 10-minute break and then we can start from stock compensation. We'll take a quick short 10-minute break. Will that fine?
Yes, sir.
So it's
Yes, sir.
11:40. Let's come back at 11:50. Today we'll be closing at 1. I have some urgent meeting at 1. So we'll close at 1. Just take a quick 10-minute break. We are not taking long break today.
Okay, sir.
Okay, sir.